This morning, we got some mixed data for the NFP report showing some interesting stuff about where the US labor market is at. And in this video, I'm going to do my best to give you a synopsis of what we saw, what it tells us, and perhaps what it does in terms of setting up for ideas in the next few days. Let's jump in. Welcome back to the channel, guys. As we get started, I just want to ask a favor of you. If you're new here, make sure you've hit that subscribe button. I know sometimes people say they've been watching me for a while and then they're like, oh my gosh, I'm not even subscribed. So help us out on the channel if you don't mind. And if you could also hit the thumbs up button, then hey, you'd make my day, and I appreciate it. All right, so we had some interesting data points come out this morning that I want to discuss and give you a little bit of my overall view on. Now, I live streamed the event and reacted directly to the spike here, which was a bit interesting. And now that the dust has settled, it actually shows, in my view, a bit of weakness overall. This week, if you've been watching the channel, you know we've discussed the JOLTS job openings numbers, which were very weak. And then you also had the ADP numbers, which is the private sector of the United States, which also looked pretty weak. And then today we got mostly, I would say, weak NFP data. Let's break this down quickly. So the big three that we're going to talk about are average hourly earnings, NFP, which is employment change, and unemployment rate. So let's start with the good news. The good news was that people were scared that unemployment rate would go from where it was 4.3 was the previous number. They were concerned that we would actually see like 4.4, 4.3 would stay. But we actually got 4.2. So the good news for this report was that unemployment rate didn't spike up massively, and that is probably where the good news ends. And I hate to be a naysayer or a downer today on this wonderful Friday, but this is pretty much where it ends, because if we take a look at NFP, I want to break this down for you here really quick. Basically, it was pretty disappointing, and I've got a chart to show you. Now, if we could zoom in on this on the edit, Chandler, appreciate you on that.
Just doing my civic duties.
If we take a look at what we see here, remember, let's start actually with last month's reported figures. So if we take a look at this one right here, let's recap what happened. The market sold off on this data point because it was very weak. The actual number compared to forecast was pretty rough. The forecast last month in their reported numbers was 176,000 jobs added. We only got 114,000, and that was all it took for the market to freak out. But today, do you see that third number, that yellow one at the bottom of the three list here? Well, that's revisions, and revisions are a subject of controversy. People love to think that there's like some sort of big government conspiracy on the jobs data point. Hey, I don't know if there is or not. I'm not here to, this is not a conspiracy channel. Maybe they are, maybe they're not. But the revisions today would be nightmare fuel for some of the conspiracy theorists out there, because they revised the previous number, which was already bad at 114,000. They revised it down to double digits, 89,000 jobs added. This is nightmare fuel, as I mentioned. That's not good news for the labor market. In fact, that looks pretty horrendous, to say the least. So starting off, revisions were creepy today. They weren't good. We revised what was already a bad number to a worse number. And today, what did we get? Well, today we got more not great, because today we were expecting to add in the U.S. economy a forecast at 164,000 jobs, and instead we got 142,000. So we missed, and we revised the previous one lower. So the way to read that is the NFP report was pretty rough. Now, the saving grace, as I mentioned, was the unemployment rate did not, get worse or get terrible, but the jobs added were definitely not very impressive. And so if we take a look at the market's reaction here, I am feeling kind of brilliant right now, because some of you guys know I was long the indices from this area here, and I decided to stop out of the S&P 500 after we broke support. This was my trigger to go ahead and take profits. I trailed my stop loss up to this point, and the markets are selling off here today off of this statistic. We've got the NASDAQ down just shy of 2% at the time of us recording, and the S&P 500 down 1.1%. So the indices are lower today, and I actually think that's very valid. But what was confusing to me initially was that we saw the opposite reaction. We initially, markets celebrated, I think, on that unemployment rate, right, not being too super threatening. But the jobs added, in my view, with the revisions, they're not looking good. This is not looking very promising. And before you, start accusing me of being a trader here, because you guys know I've been very bullish on indices this year, I'm just calling it as I see it. I am, I'm being as honest as I can here. I've been very bullish on the indices, but this calls into question what we're looking at. And there's something else that we've got to talk about or bring back up from the Edge Finder that warned us of this. Do you guys remember this chart? We discussed it on the first trading day of September. We talked about seasonality. And this is why trading data, when used appropriately with good strategies, can save you or make you thousands of dollars, which is exactly what it did for me. I saved thousands of dollars by stopping out of my position because I got skeptical. The Edge Finder score for the indices dropped dramatically, and I decided, okay, I'm going to tighten up my stop loss. I got out of the way, and I'm patting myself on the back here a little bit, but it truly is a good case study for why data matters. What we can see here is that seasonally, the month of September is not a good month for the indices. The SPX 500 in the last 10 years has averaged a negative gain during the month of September. So I want to bring this up, not out of spite, but out of warning that if you're not looking at data, you're missing really important stuff in the financial markets. All that to say, what a great time for me to drop a sales pitch for you. The Edge Finder, the 35% off sale is ending today. So if you're not already a user, a proud user of the Edge Finder, then today's your day. You got 35% off by using the first link in the description. We'll have some members of our team ready on standby to answer any questions. You can pay with crypto. You can do payment installments if that's easier for you. You can find out more information about the tool, or you can ask any questions you have about it. So make sure to click that first link in the description. If you've thought about it, there's your chance to get 35% off. Sale ends today. Okay, so again, sales pitch aside and jokes aside, genuinely, the tool is a great fit. And I want to mention something else. It's a great fit for fundamental aspiring traders who want to simplify this stuff. You don't have to be a data engineer. You can just use tools like ours where you can get more information more quickly. And as traders, isn't that the goal, right? The goal is to use as much insights to build an edge as you possibly can. The commitment of traders data comes out later today. Now, we can't look at it right now because it hasn't come out yet. The last update was August 30th. The data will come out. Actually, it might be delayed. I just thought about this as I'm recording this video. Monday was a U.S. holiday, so it's possible that the COT report will get pushed back until the following day. So we may not get COT data, but when it comes out, it'll be so interesting to see what they've done during this week. What is institutional money buying or selling? We will get updates on that. And of course, it will be displayed here as soon as the new data is pulled from the software's automated scripting. So with indices trading lower, again, I'm feeling glad that I'm out of them, but I'm also wondering, at what point do we look to buy again? Well, right now, I don't have any signals that are telling me, okay, get back in long on the indices, right? We're seeing a potential lower high here, right, forming. Now, I can't really say like, oh, the market is just outright bearish from here, but there's enough signals here that are keeping the score low. Let me show you. So I'm on the Edge Finder's top setups page, and I'm going to filter specifically for indices, and I'll show you the current scores that the indices that we track on this software are currently giving us. And what you can see is we're getting mostly neutral readings. And this is what I mean when I said earlier that this has helped to save me thousands of dollars. In my personal trading, the way I use the Edge Finder is I'm keeping an eye on what the bias currently is. And if it switches to neutral, I'm much more cautious with my positioning. So here we go. We've got several things here pointing more towards a bearish or neutral reading, right? Seasonality, as I just mentioned, is factored into the algorithm. And that algorithm is pointing me towards neutral, which again, saved me a lot of money because I chose to then trail my stops tighter, got out of the trades quicker, and suddenly, the markets are down pretty big in the last week. So anyways, that's what I'm looking at when it comes to the indices is I'm waiting for something here, waiting for a trigger to give us more confirmation on the indices before I jump back into them. Next up, I want to discuss gold. And I know a lot of traders here are probably wondering about gold. Gold is also getting a neutral reading currently. And if you're wondering about that, I want to show you something. I promised I'd build this table, and I did get to it. So now we are looking at the Edge Finder's gold data scanner. And what we can do with this is we can go piece by piece the fundamental data behind the scoring for the Edge Finder's neutral reading. And this is why when it comes to gold, I'm not incredibly bullish or incredibly bearish at this time. I do have a long position that I took like 12 days ago or so that I'm just holding on and trying to trail stops on. But you can see we're sitting at a neutral reading, and there's a lot of red over here. What that red signals is that when looking at economic data points, we're getting weakness or maybe strength that is negatively impacting gold. I'll give you some examples. GDP growth came in better than forecasted. That's not good for gold. Remember, gold thrives on fear and uncertainty and rate cuts. So when we also see manufacturing PMIs, this is a good one, right? Manufacturing PMIs were weak. That's actually positive for gold. You kind of have to rewire your thinking here on the fundamentals for a moment, but I'm going to walk you through it. So don't worry, I gotcha. Services PMI was slightly better than expected, which is considered more bearish for gold, right? And then retail sales also better than forecasted. That's bearish for gold. CPI year over year is cooling off, which is good for gold because that signals rate cuts are coming. Core CPI was a little higher than expected, so that's not particularly great for gold. And then, so that's where we're getting a mixed reading on the inflation category, by the way. Then we can take a look at NFP today, right? So NFP, when we take a look at the forecasted versus expected, actually, I think that this is the wrong data point. I've got to adjust this. But we missed expectations, right? And that actually should be positive for gold. It is correct in the scoring here, right? It's just this table. I got to rewire this a little bit, but that should be fixed this afternoon. And then finally, unemployment rate, right? Unemployment rate actually came down to 4.2%, which is a positive thing for the economy, which is not particularly good for gold either. So this is why we're getting a neutral reading, and this is why I'm not super bulled up on gold. And when we take a look at gold's performance today, it's kind of flat and unimpressive. Yeah, I mean, the Fed is going to cut rates. The economy is not in dire straits, but it's definitely not in a great situation either with the jobs data coming in light. So I go back to my game plan that I discussed yesterday. If jobs data came in horrible, I'd look to add. We didn't quite get horrible. We got bad stuff this week, but unemployment rate ticked lower. So there's kind of like this neutral. And let's check the FedWatch tool for more clarity on what would have caused gold to spike dramatically. People are wondering, why isn't it? Well, if you had gotten a chance for a 50 basis point cut to go massively higher, then yes, gold would be much higher than where it currently sits. But we didn't quite see that. I'll show you. So going into today, what we saw on the FedWatch tool, I should have screenshot it, but I didn't. We had a 45% chance of a 50 basis point cut in this month. We only ticked up by 4% to 49%. So you can see, if you're wondering why there's not a huge move in the gold market today, it's because expectations for rate cuts didn't change all that much. And not changing all that much means gold doesn't get excited. Remember, gold wants to see more rate cuts if it's going to be bullish. Why? Well, because that means a weaker dollar. When you cut rates, it's generally bearish for the currency. There is an inverse correlation most of the time between gold and the dollar. So we didn't see some huge, meltdown on the dollar today, which would have been the catalyst for a higher price in gold. Speaking of the dollar, let's take a look at the price reaction today. You can see it's kind of mixed, right? You had a move up, then you had a move down, now back to where it currently started. So when I look at the dollar here, I will say I still kind of lean dollar bearish. I thought today's jobs data was not exciting, and this week's job data was poor. You had JOLTS job openings looking bad. You had just a whole lot of negative, and I don't love to talk on how concerning the economy looks. It sounds like I'm coming across negative, but as a trader, I've got to trade what's in front of me, and what I see in front of me is a week full of weak data. Right? Well, it's not all bad. You've got GDP numbers. Again, I went through that economic data table with you. Some stuff's looking okay, but it seems like more things are signaling that we could have trouble stewing in the economy. Now, I want to finish this concept here with the concept of, am I more in the soft landing camp or am I in the hard landing camp? Remember, if you're newer to fundamentals, the Fed is expected to cut rates in this month and begin a campaign of cutting rates going forward. And people are debating heavily if we're going to get a soft landing, meaning the economy is okay and they're cutting rates into that and the economy can reaccelerate and do okay, or a hard landing where the economy is crashing and rate cuts are just an attempt to try and save a slippery slope system. I would say that this week contributed more, gave more points to the hard landing concerns, but that overall, the soft landing story is still somewhat intact. Now, what do I mean by that? Well, GDP numbers are not crashing. You have services PMIs doing okay. There's enough here where I can say the economy is showing signs of weakening, but it's not showing signs of absolutely outright crashing. And that difference keeps me more in line with, okay, this dip that we're seeing in September, I don't necessarily think turns into an outright stock market crash, but it is possible that we go back and maybe retest some lows. Maybe September is just a reset month before the end of the year kind of picks up and we see a bit of a rally. So my take on this is I am on the sidelines. I'm feeling very happy that I am because the markets are lower today. But I'm looking to buy the dip creatively. I'm looking to be patient and wait for some signals to form on the edge finder and price action before I jump too quickly into indices. Again, on the gold front, as I discussed, I'm looking for a breakout. I'm looking for some signs that we're going to continue. Otherwise, I'm just going to keep my small position that I do have on and wait for either a break and retest or to get stopped out, one or the other. So that's kind of where I'm at, guys. I hope that you traded safe, traded okay during the NFP report. It was a wild event. And if you'd like to watch the reaction to the NFP spike, we'll end today's video with that clip. So last thing I'll say before that is if you guys are interested in getting access to the Edge Finder for that huge discount, that 35% off discount, don't miss it. It's the first link in the description. Thank you for watching today's video, but check out this clip before you go. It was kind of an interesting event. Let's see how NFP impacts the markets. All right, euro is lower, dollar index higher, NAS higher, SPX higher, US 30 higher. Gold is lower here on that print. Let's take a quick look and see what we've got in terms of numbers. Should be dropping. There we go. We had a less than expected non-farm payroll come out and 4.2% for unemployment rate. So unemployment rate did actually come down slightly, which is positive. You had higher than expected average hourly earnings, and NFP came in light. I would actually say that's not a particularly bullish report here for stocks. We got gold moving higher because that makes sense. You got a little bit of weakness in the jobs data, right? Gold is moving higher off of that. And at the same time, unemployment came in as expected, but noticeably, alongside this, you got a little dose of inflation coming in, 0.4% as opposed to 0.3% for the average hourly earnings month over month. Remember that earnings are a huge contributor to inflation, right? If you get people getting big raises in this economy, inevitably what that means is that it becomes inflationary. And so everybody wants a raise. Don't get me wrong. I'm not saying anything bad about that. I would like a raise. We'd all like a raise. But as an economy, if everyone is getting raises, the tricky part there is that it causes inflationary concerns. And so at the same time, we've got a move lower in, the dollar is now completely reversed. Look at that. You've got NAS down from the spike highs, SPX, US 30, all of them erased those moves and now just kind of sitting flat. And look at gold, guys. Are you kidding me? Why is gold moving higher? Oh my goodness. How did I miss this? Holy crap, guys. We got 114,000 last time, and that freaked the market out. Look what we got this time. We got 142,000 compared to the 164 forecasted. We reacted to that first, but did you miss the revisions? Do you guys see the revisions right here? Look at this. We were last time we got 114,000 jobs and people freaked out about that. They just revised that number down to 89,000 jobs. Guys, we're not even in triple digits for numbers of added jobs last month. Oh my goodness. I'm actually surprised we're not seeing a bigger reaction to this. That is actually horrible. If you're looking for a better brokerage, then stick around for a second. I'm going to tell you how you can get some free sign-up perks with great brokerages all around the world. Whether you trade FX or indices, commodities, futures, all of the above, I'm going to show you a really cool way that you can get free sign-up perks with your new account. So if you're interested in switching into a different brokerage, you can get things like deposit bonuses or free stock shares, or you can even get access to some of our products for completely free. All you have to do to find out current perks being offered to new depositors is go to a1trading.com/brokers. That's a1trading.com/brokers. And as you look at that page, you'll see all these different offerings that we've currently locked down for you guys as subscribers, as viewers. Now, of course, we get something out of this. If you choose to use these links, you'll be supporting our page. But in return for the viewers, we've got great sign up perks available for you guys so that you get some free game just by signing up for a brokerage if you're looking to do so. So check it out on our website. You can find current deals at a1trading.com/brokers. Thanks for watching this video, and on the screen right now, you'll see some other options of other videos we put together that might be helpful to you in your trading career. So thanks for watching, and we'll see you next time.